Welcome to the deep dive. This is where we unpack the sources you send us and really pull out the key nuggets of knowledge.
That's right.
Today, we're taking a fascinating trip, really, back to the late 1950s. We're looking at a specific source, a 1959 letter from Warren E. Buffett, dated February 20, 1960.
A classic.
Yeah. So our mission today is, well, to see the 1959 market through his eyes, understand his thinking back then, his early philosophy.
And see how his partnerships actually did in what he called a peculiar year.
Exactly. What was he seeing? You know, what were others missing? How did he handle a market that seemed to defy logic?
And this deep dive, it isn't just history. It's really a chance for you to get insights into, critical thinking, value investing.
Right.
We'll look at how a market that looks strong can hide some real complexities underneath, and how one investor just stood apart.
Defining a legendary strategy, really.
Absolutely. So get ready to see the market a bit differently. Understand why those headline numbers, they don't always tell you the whole story.
Okay, let's get into it. So the paradox of 1959. On the surface, looks great. The Dow Jones Industrial Average, everyone knows the Dow. It went from 583 up to 679. That's a 16.4% gain.
Strong number.
And then you add dividends, you're looking at nearly 20%, 19.9% total gain. Sounds like a boom, right?
It does. But here's where Buffett's letter calls it somewhat faulty, that picture.
Faulty, okay. So what's behind that?
Well, we need to look deeper, like he did. Despite the Dow climbing, more stocks on the New York Stock Exchange actually fell that year.
More decline than advance.
Yep, yeah. By 710 to 628. And, importantly, the Dow Jones Railroad Average, down. The utility average, also down.
Wow. Okay, so the main index is roaring, but under the hood, lots of sputtering.
Exactly. It shows the market wasn't, uniformly strong at all. It wasn't lifting all boats.
That's a huge disconnect. So if the broader market beneath the Dow was struggling, what about the big players, the investment funds, the supposed experts? How did they do?
Good question. The letter points out that most of them, the investment trusts, they actually had a pretty tough time compared to the industrials.
Really? Like who?
Well, take Tricontinental Corp. Biggest closed-end fund back then, like $400 million in assets. Huge for the time.
Okay. And their return?
Only about 5.7% overall gain.
5.7 compared to the Dow's nearly 20.
Big difference. And their president, Fred Brown, he even said markets driven by investor sentiment and enthusiasm like 1959, they're tough for managers focused on value on the long term.
And wasn't there that quote about space boots?
I think that's the one. He quipped, perhaps we haven't had our space boots adjusted properly.
That perfectly captures it. Like they were just floating, disconnected from this weird market gravity.
It really does. And it wasn't just them. Massachusetts Investors Trust, the biggest mutual fund, $1.5 billion, they only managed about 9% gain for the year.
So 9%, still way under the Dow.
Way under. So this gives you listening some really crucial context, right, for what Buffett was navigating. The pros were finding it tricky.
Okay, so that sets the scene. Difficult market, professionals struggling. Now let's get into Buffett's mindset before we even look at his numbers. The letter says he'd been very apprehensive about general stock market levels for several years.
Right. And that's key to understanding his whole approach. Long-term thinking, risk management.
He wasn't just reacting to 59.
No. He thought the prices of blue-chip stocks back then had a substantial speculative component, a big risk of loss baked in.
Speculative component.
Yeah. He wondered if maybe new valuation standards were taking over, but he said, I don't think so.
Sticking to his guns.
Definitely. And then there's that famous line, I would rather sustain the penalties resulting from over-conservatism than face the consequences of error, perhaps with permanent capital loss, resulting from the adoption of a new era philosophy where trees really do grow to the sky.
Wow, trees really do grow to the sky, that new era thinking. He was pushing back hard against that hype.
He was. He saw the danger in getting caught up in that kind of euphoria.
But did he acknowledge that maybe his caution meant missing out on gains? The market had been going up.
Oh, absolutely. He put it right in the letter. To date, this caution has been unnecessary. He knew he might have left money on the table, so to speak.
Okay.
But for him, that risk was acceptable. The unacceptable risk was permanent capital loss. Avoiding that big mistake was job number one.
So that conviction, that discipline, that's a huge takeaway for you as an investor, sticking to your principles even when the market seems to be saying you're wrong.
Precisely. Capital preservation above all else.
Okay, so now the big reveal. Against this backdrop, the weird market, the struggling funds, his own apprehension, how did his partnerships actually do? He'd kind of set expectations low for rising markets, right?
Yeah, he'd said expect, relatively unimpressive results in rapidly rising markets.
And 1959 was a rapidly rising market, at least according to the Dow.
It was. Yet, he says he was fortunate to achieve reasonably good results.
Reasonably good. What did that translate to?
Well, the 6 partnerships running the whole year, they had overall net gains from 22.3% up to 30.0%.
Whoa, okay.
Averaging about 25.9% across them.
26% average, when the big funds were doing 5, maybe 9%.
Stark contrast, isn't it?
That's incredible outperformance, especially given his cautious stance. But he mentioned something about how that gain was calculated. It wasn't based on actual realized profits.
Right, a good point. He was very specific about that. The gain was based on market values at the beginning and end of the year, adjusted for payments made to partners or contributions received.
So more like a change in the portfolio's total worth.
Exactly. He wanted to measure the change in liquidating value, what it would be worth if they sold everything then and there. It gives, a truer picture of wealth creation for the partners.
Rather than just what stocks happen to be sold that year.
Precisely. And he also notes, very typically, that this is after expenses. And he even calls out the Nebraska intangibles tax.
Ah, yes, the Nebraska intangibles tax. What was that about?
It was basically a state tax, new that year, or newly enforced anyway, about 0.4% of market value on most securities. He mentions it specifically penalized their results by that much.
That level of detail, focusing on the net return after everything, even a small state tax.
It shows his meticulous focus, always thinking about the partner's actual take-home return.
Okay, let's shift to the portfolio itself. How did he achieve those returns? He mentioned a new commitment from the year before that had grown quite large.
Yes, it had. By the time of this letter, it was about 35% of assets across the partnerships, which he himself called an unusually large percentage.
35% in one thing. That's a concentrated bet. He must have had, as he said, strong reasons.
He did. It's fascinating. He describes the company as partially an investment trust. It owned like 30 or 40 other high-quality stocks.
Okay, so it held other securities.
Right. But crucially, his partnerships bought into this company at a substantial discount from asset value, based on the market value of the securities it held and a conservative value for its operating business. So, classic deep value.
Buying $1 for 50 cents, essentially.
Kind of, yeah. But there was more. He also points out influence. They were the company's largest stockholder by a considerable margin.
Ah, so not just passive investing.
Not at all. And he says the 2 other large holders agreed with their ideas, so they could likely push for changes to unlock that value.
That sounds like activist investing, almost, way back then.
It has elements of it, certainly. Identifying value and having a mechanism or influence to realize it. He felt there was an extremely high probability it would outperform the market until they sold it, hopefully that year.
Okay, so that's a big chunk, 35%. What about the other 65% of the portfolio?
That part was in what he called securities, which I consider undervalued in workout operations.
Undervalued, that's standard Buffett. Workout operations, what are those?
Those are special situations. Investments where the profit comes from a specific corporate event happening, like a merger or a liquidation or a spinoff.
Ah, so less dependent on the overall market going up or down.
Exactly. Their outcome depends more on the deal completing than on, say, the Federal Reserve's policy or general market sentiment.
So that ties into his core policy, which he stated was to attempt to invest in situations at least partially insulated from the behavior of the general market.
Precisely. Build a portfolio that doesn't just ride the market waves. This insulation, he believes, should lead to superior results in bear markets because his stuff wouldn't fall as much and maybe just average performance in bull markets.
Although 1959 certainly beat average.
It did, but he was already anticipating a test. He notes in the letter, written Feb 1960, that the Dow had already given back over half its 1959 gain.
Foreshadowing, maybe? Testing that insulation idea?
Could be.
So wrapping this up, what does this deep dive into one letter from 1959, well, what does it really mean for you listening today?
I think the takeaways are pretty clear and still incredibly relevant.
Yeah.
First, always look beyond the headlines. That Dow number in 1959, totally misleading about the market's underlying health.
Right. Don't just take the index number at face value.
Second, understand how market sentiment, that enthusiasm Fred Brown mentioned, can create huge disconnects between price and value, between headline performance and reality.
And third,
consider the power of a disciplined, value-focused approach. Prioritizing not losing money, seeking investments somewhat insulated from market whims, even if it feels over-conservative sometimes.
Especially when everyone else seems to be caught up in a new era.
Exactly.
Which brings us to, I guess, our final provocative thought for now. In today's world, where we still hear about new eras, where investor sentiment and enthusiasm definitely play a huge part, how do you tell the difference? How do you know when maybe the trees are growing to the sky versus when they're just rooted in solid, maybe boring value? What space boots, to use Fred Brown's term, do you need to adjust to navigate what's ahead?
Yeah. And what underlying truths, like Buffett saw in 1959, might you be overlooking right now because the headlines are shouting something else?
Something to think about.